Good morning, everyone. Hello, we are going to be together for the next hour to talk about the new power prices paradigm. The idea of this webinar for us is to present a few outtakes on the impact of the energy transition to power prices at multiple levels. We'll be focusing at the European level and discuss topics like the effect of low and negative prices on renewable investment in Europe, potential solutions, or ideas for a clean and competitive European future. I'm Baptiste Posseme. I'm the manager of the Power System Department at Enadata.
And I'm Adrienne de Basler, and I'm a Power System Analyst at Enerdata.
Okay, we are going to first discuss, give a bit of context and a general overview of long-term trends on the impact of energy transition on the electricity sector, on the power sector. Then we're going to focus more on the day-ahead spot market. And finally, we'll talk about long-term trends on power markets. In particular, we'll give a bit more detail about our new product on power prices projections. But first, I want to give a few words for those, if there are still some here that don't know Enerdata. Very short, but basically Enerdata, we are a 30-year-old company based in France, and we focus on energy markets at three main levels. First, we gather data. So we have very large databases of energy-related data on energy statistics, on market players, on projects. I won't detail everything here, but the idea is that this complete set of data on data on historical and the current market situations allows us to produce production and demand scenarios, which is in data's, I would say, core expertise, one of its historical expertise. We particularly focus on the evolution of energy demand, and we'll see later in this webinar that it has strong implication on the evolution of power prices. And in particular, we rely on an in-house model co-developed with multiple laboratories and used in particular at EU level, the POLS model that is used to do long-term scenarios of energy demand and production. And the key product that we wanted to discuss also today is our more recent power market model. We will present it in more detail, but the idea is that we've been developing for the past year and a half, a model, dispatch model to reproduce the behavior of power markets throughout Europe for now, later for other countries. And we'll use that also to disclose some information on the third part. And to finish, our last core expertise is market analysis, for which we can capitalize on both our projections and our data. Okay, let's start with a bit of context. I'm not saying anything new if I start by saying that to achieve the energy transition, a key role has to be taken by the electricity sector, by the power sector, at two main levels. First, there needs to be an electrification of energy demand. So a switch from the use of fossil fuels to electricity, but that alone is not enough. There need also to be a transformation of the power sector, in particular, transition from fossil-based technologies to low carbon technologies. You know the usual suspects. I'm speaking PV. I'm speaking wind, nuclear, biomass, and where it gets interesting is that achieving the transformation implies a shift in terms of remuneration, in terms of business models for market players. Basically, the power markets today have been historically built for power plants like gas, coal power plants, for which most of the cost is based on their marginal cost. Meaning, if you take a gas plant over its lifetime, most of its cost will be fuel, will be gas, basically. It's not the case with solar, it's not the case with wind, it's not the case with nuclear. Meaning that we have an increasing penetration of technologies with a low or null marginal cost. When those technologies are still a minority, it doesn't change much the power models, the power system. It doesn't change much the results of the spot market. When they start to become the marginal capacity, the highest cost production capacity on the power market, it starts to have strong implication, and we'll see that later, but it's something that we can already see right now. So what we're going to disclose, it's at European, what first are the main indicators of producers' remuneration and how will those remuneration model evolves. We'll look first at very quickly from an investment perspective at tree level, production, grid, and flexibility. So to start with production, I will go quite fast on this one, and you will have the presentation afterwards. But the main idea is to say that we've been over the last 20 years, pretty much, there has been a decrease of thermal and nuclear capacity and a strong increase of wind and solar installed capacities. Again, warning, capacity is not production. So I'm just talking about installed capacities here. What we show on our top right graph here is in our blue scenario, meaning at our data in our pose model, we output every year 3 key scenarios. I will use those terms a lot, so I better start explaining it now. In our base, which is a business as usual scenario. In our blue, which is stated policies scenario, and in our green, which is a world in which we had successfully achieved less than 2 degrees of global warming. In our blue scenario, what we can see is that over almost the same time length, there needs to be a very strong increase on the development of solar and wind. The key takeaway here is that even if those, once they are installed and with decreasing LCOEs, there might be a lower overall cost on the system in the long term, there needs to be an investment period. There needs to be an increase of annual investments in the EU 27. We try to translate that in the graph on the bottom right here on annual investment just for installed capacities. And you'll see that there is a growing need for CapEx. But that's not the only part that we need investment. Achieving this transformation of the electricity sector will also require a strong increase of grid costs. There is no consensus today on the level of grid cost that will need to be achieved by 2050 to successfully achieve the transition. However, there is a general agreement on the fact that grid costs are going to increase overall. On the right here, I showed a bit of graphs from Eurelectric, from Acer, for instance. But the general idea is to say that we will need first to replace the aging network, current network, what's called here the legacy grid costs. We'll also need to adapt the grid to the development of new uses, electrical vehicles, for instance, electrification of industrial processes, increase of peak electricity demand at residential and services level, for instance. And third, since we are we have already started actually to shift from a centralized power production to a decentralized, to a distributed one, with the development of smaller capacities. And even when we are talking about 5 megawatt solar power plants, it's still very small compared to what is usually a coal or a gas power plant today. So those 3 points mean that there will need to be an increase of grid cost. However, how much will also depends a lot on political choices. Uh, what will be, for instance, the evolution of tariff structures? Who will pay for those costs, and what will be the incentive for end users and for TSOs and for DSOs to adapt their technical decisions, and also if we increase the overall cost, it doesn't necessarily mean that we'll increase the cost per user. It will also depend a lot on the evolution of power demand, of course. And one of the key challenge for TSOs and DSOs here is to avoid what we call golden plating, basically overbuilding distribution and transmission capacities for a demand that might not be happening or later than expected. The third axis that I want to develop on the evolution of investments is that there will need to be a strong increase of flexibility capacities. Flexibility, it's kind of a large term that's kind of multiple definitions. What we usually use is the capacity for the grid to supply upwards and downwards adjustment for power production to match demand. And when we talk flexibility, we were speaking, of course, about storage assets, but also on the demand side, on power generation assets, which are the one today that supply the most flexibility to the grid, and finally also to grid infrastructure by the development first of interconnection, cross-border interconnections, but also of the use of innovative grid technologies that can help reduce the need for grid cost. Then again, it's important to keep in mind, I think most of you know it already, but it's still important to always have it in mind that when we talk about the cost of electricity, the cost of the energy part of the electricity bill, it's just for domestic consumers usually a third of the total bill. The rest is grid tariffs and taxes, which might include, for instance, capacity markets taxes, also socialized subsidies, for instance, for the remuneration of feed-in tariffs, of other remuneration schemes. Why I won't go into much detail here, but you can see on the graph on the right here, the orange part's the energy part, that we had a strong increase during the 2022 energy crisis that was partially compensated by the decrease of taxes and increase of subsidies by governments. But still today, last year, let's say, at least in 2024, we still have pretty much this share of between taxes, tariffs, and energy part. I said earlier that we're going to talk a lot about the spot market, in particular in the model that we've been developing at Data. We've been focusing so far on the day-ahead spot market. Why? To answer that, we need to go a bit deeper into the market players' remuneration schemes. So basically, when you have an electricity consumer, he is going to buy its electricity from a supplier. He can do it himself if he's a large consumer. This supplier is going to buy electricity at multiple levels. It can use its own production assets if it has some. It can also buy its electricity directly on markets, on Apex, on Nord Pool, for instance, and on those markets, it will be able to buy both spot electricity, meaning electricity that for which the price is defined every day for the next day, but also futures, so long-term prices that can go up to 3 years in advance, for which that helps secure volumes over the long term. But the key point here is that those long-term prices are usually the translation, the interpretation of the market of what will be the spot prices in 1 year, 2 year, 3 years. And that's why we focus on the spot market. That's why most prices, most supply today is built on this price. A supplier can also have direct contracts, of the counter contracts with single producers, with multiple producers to an aggregator, for instance, through a corporate PPA. But then again, the price will be not directly, but will be directly influenced at least by the capture price of the producing technologies. I'll go into more detail on what the capture price is later, but basically is what a solar power plant, for instance, could hope to get if it sold its electricity on the spot market. And again, it will be able to benefit, for instance, from long-term supply contracts or from other subsidy mechanisms like AREN in France, to give an example. On the producer side, the producer will have similar options. It will be able to sell directly its produced power on the markets, on the spot or future markets. It will also be able to trade its capacity on capacity markets for countries that have some, or during a single day to exchange on flexibility markets for additional remuneration. It can also have long-term contracts, of course, through PPAs, but the important part is that a large part of renewable producers directly benefit from public subsidies. We're talking about feed-in tariffs. We're talking about contract for difference, CFDs. Additionally, they can also benefit from guarantees of origin. And those subsidies are one, not the only one, but one of the key explanations of what I'm going to present in the next slide. So now, if we try to give a bit more detail on the spot market, let's look at the evolution of the spot markets over the last 5 years. Basically, to summarize, before 2021, we had low prices, we had negative prices. I've shown here on the right graph comparison of the hourly spot price in Spain and Belgium over the last 5 years. But most of the time, a very large part of the time, the price was defined by the marginal cost of either coal power plants or gas power plants. In 2021, especially starting October 2021, I think most of you, all of you, know that we had a very complicated period in terms of energy prices. We had a very strong volatility of prices driven by an increase of gas prices, partially explained by the invasion of Ukraine by Russia, but not only. We already in 2021 we had very low gas stocks. We had an expectation of low wind production, for instance, for the 2021-2022 winter. We had the development of issues on the French nuclear power plants at the end of 2021. So the correlation of all those factors started a very strong instability period that lasted until, let's say, the beginning of 2023. And when I'm saying this, I'm saying that since 2023, we do have much larger daily spread, a much larger variability of power prices. You can see here on the graph that on the right part, we reach prices at zero almost daily. But those prices are much more predictable. For people like us that are trying to reproduce the behavior of power markets using models, basically we managed to do it quite well before 2021. After 2023, not so much between 2021 and 2023. And you might have seen it on the last graph. I mentioned it. We had a strong development, especially since 2024, of negative prices. A lot has been said on those prices already, but to give a few explanations on why such prices happen, because it can seem counterintuitive for a power market player to sell electricity below zero. It can be explained by multiple factors. First, the fact that we have power plants that are not correlated to the market. For instance, I mentioned earlier renewable producer benefiting from feed-in tariffs. So they inject their electricity on the market, on the grid, but do not are not incentivized by market prices, except for special conditions or special tariff during negative hours. I'll go maybe into that later, but the general idea is that when you have, for instance, on the left here, you have the example of a typical day in Spain. When you have like this during the day, a strong production of solar power, wind, that even if wind is lower during the day, it's still not null. You have the nuclear power plants that cannot go below a given level. You have gas power plants that some of them are, for instance, dual producer. They produce both heat and power, so they need to produce their heat to, for instance, for heating network for an industry. So there is a minimum production of gas below which we cannot go, and hydropower also as a minimum of production to have. And in this context, for instance, the gas producer that needs to sell its electricity on the market, since it needs to produce absolutely, it will be able to price below zero. And we've seen, and we've shown it on the right tables here, that the having low and negative prices, I said before, it's nothing new. At least in most countries, it was new, for instance, in the Iberian Peninsula. But the development in 2024, and it's even worse since the beginning of 2025, is something that was never seen before. Very briefly, but because it will relate to something that we'll show later, but those negative prices tend to happen during the middle of the day, so when solar production is at its peak, especially during the weekends when the demand is lower, and in particular during spring and the beginning of summer months, where electricity demand is low. There is less heating, there is no cooling at this moment, industry is running, and solar and wind production is already high. And indeed, if we try to explain the development of those low prices, two key factors needs to be taken into account. The first one is the penetration of renewables. I mentioned at the beginning the development of solar and wind in Europe. And the good news is that we are, especially for solar, we are rather on track with the scenarios outputs on what should be installed year by year to meet objectives. It's not as much true for wind, which only installed, I think, 16 gigawatts last year. But so there is a growing penetration of renewables. This growing penetration of renewables is combined with a lower than expected electricity demand. On the bottom left here on the graph, you can see the EIA's production for the EU electricity demand, what they said in 2024, and then again 1 year later in 2025. As you can see, the demand for the coming years have been reduced. The projections have been reduced. And indeed, while a few years ago, most people expected a strong development of demand electrification, this electrification is still lagging behind the EU, at least. And on the right here, you can see that the difference between, so the top graph is the share of non-dispatchable power plants, so solar, wind, hydro, over the year, compared to their share during low prices hours. And you can see that, for instance, in Germany, during low prices hour, we reach levels of solar and wind that are up above 60% of the total production, and even more if we take specific hours. What does it mean for market players? I said earlier, when you sign a PPA between a power producer and a supplier, this PPA level will be indexed, usually indexed or defined based on what the expected capture price of the technology is. Meaning, if I sell the electricity produced by my wind power plant, by my solar power plant on the market, how much will I get? And that's what we show here on the right graph, is the comparison of what a renewable producer would get compared to the average spot market. And if you see the different line colors here, you can see that, yes, wind always had a lower capacity factor, around 80%. It's sometimes decreasing, sometimes increasing, but where it gets really important is for solar. And solar, especially since you can see the evolution in 2023, 2024, and it's even stronger since the beginning of 2025. A decrease of this capture rate, especially during spring and summer months. So warning, the y-axis does not start at 0, but for instance, in April 2025, it means that a solar producer would sell its electricity around 40% of the average spot market, which is of course a strong decrease in terms of revenue for this market player. This can be limited to some extent because first, the technologies that are benefiting from subsidized contracts, feed-in tariffs, CFDs, they are not impacted directly by this capture price. They can be impacted because some CFD contracts, it's the case in France, it's the case for feed-in tariffs in Germany, in Italy, in Greece, if I'm not mistaken. I'm probably forgetting some, where you have to curtail your production during negative hours. The question now is that we are at the beginning of a trend that does not have a particular reason to change in the coming years. So how can we expect it to evolve, to develop over the long term?
Hi, so I'll be taking over from now. So how can we model power market evolutions on the long term? If we want to know the short-term prices, maybe in the next 2 weeks, it's more likely we'll be using statistical or econometric models. Also, we can use regression models. All these models are pretty fit to address short-term forecasting for market prices because they mostly reproduce what's been happening, the behavior of the market. So what's been happening over the last few months and the last few weeks. but because they reproduce historical behaviors, they are not very good at forecasting or anticipating power system evolution, like the power mix changes, which capacities are installed. So on the longer term, for example, up to 2050 forecast, we are more likely be using capacity building and dispatch models. So these models are optimization model often, and they rely on the fundamental simulation of a power system, meaning the installed capacities and the unit commitment. And also with capacity building, it means how much of which technology should be installed. And these models are very useful to plan, to forecast what we call spot price, because what they return is a marginal price of a power system. And the marginal price is closest to what the day ahead spot price is on today's market. And at Data, we developed a model, and it relies on two distinct models. First, we use Pulse. Pulse is a project that's been developed at Data for many years, and this model is a partial equilibrium model. It basically models a multi-energies system at a global scale. So all energies are considered, meaning oil, gas, electricity, but also CO2. And it's a global scale, meaning worldwide scale. And each market has its own offer and demand curves and equilibrium. An overall equilibrium is achieved. And with this model, we basically get data that we can feed into a fundamental model called a dispatch model. And this is a power dispatch model that basically simulates which power plants should be turned on or turned off. And from this fundamental dispatch model, we can deduce marginal cost and thus spot price. So to delve a little bit more in detail, so on the left side, you have the outputs that we take from the Pulse model. So Pulse is has a yearly time step. As I said, it covers all types of energy, and it is three scenarios are developed inside of Pulse. And there is the NR-based scenario, and I'll also be speaking about the NR-blue scenario. So basically, NR-based is business as usual scenario, and NR-blue is a scenario that takes into account the NDC of countries, so the targeted transition goals of countries. And so we take from NR Future From NR Future, we take the installed capacities for each technology and each country and each year. We also take the electricity demand at a yearly level, so the aggregated annual electricity demand, and we also take the commodities prices. So by commodities, I mean the gas prices, the oil prices, the CO2 prices. All these prices and all this data are fed in the fundamental model. So basically our power price projection model. And this model relies on the PIPSA package. And this model has an hourly time step and allow us to forecast prices at an early time step, of course. And it covers only the electricity market. And we so far have been running this model up to 2050. And if we delve a little bit into detail regarding the evolution of our data, so the input data. So right here on the right, we have a graph of fossil fuel generation cost. There is a distinction that has to be made here. So we speak of generation cost and not marginal cost, because this generation cost includes also the efficiency of the power plants, and also the CO2 prices. This is why, for example, for coal power plants, we have not only a single dot, but a scope of what could be the generation cost, because there are various power plants efficiency, coal power plants efficiency, meaning we don't have one single price. So if we comment a little bit this graph here on the historical data, so from 2020 to 2025, sometimes gas has been more expensive and coal was less expensive, so we would run coal power plants. But on other times, coal was more expensive, and so we would run gas power plants. So there was no systematically, none of gas or coal was systematically more expensive or less expensive than the other. However, what we see from the year 2030, but especially from the year 2040 and onwards, is that coal power plants will become more expensive to produce electricity with than gas power plants. This is mostly because we expect a slight increase in CO2 prices up to 2050. And this enables a structurally lower gas production cost. So gas will be more cheaper to produce electricity with. Now, if we focus on another input data, of course, is the electricity demand. So the electricity demand we use in our models are from Enerdata. So it's the orange bars, and we have the three scenarios from the Pulse model. So we have Enerbase, Enerblue, and Energreen. What we see here is that the Enerdata demand is much lower than the other scenarios. So scenarios from Total Energy, from the IEA, from the ENSOE, TYNDP projects, and also from Eurelectrics. So it means that Enerdata has more conservative demand hypothesis than the other scenarios, especially in 2050. The difference is very stark. And yeah, it's more conservative, but it's also closer to historical data. Historical data here are drawn on with a dotted line. And one reason why Enerdata has much lower demand hypothesis is that, well, it's from the way we model. We have a partial equilibrium model that gives us what is the demand forecast. And it differs from the political objectives, which are more included in the IEA or the ENSOE demand forecasts. Now, if we move on to the spot price evolution. So this is a result from our model. It's actually a mix of historical and forecasted data. On the right side, so we have monotones. Basically, a monotones of price is you take all the prices that happened on the market during a year and you sort them by increasing order. So if we take the blue line here, we can say that, for example, the price has been below 100 euro per megawatt hour during at least 4,000 hours of the year. So a short comment on these curves is basically if we compare the 2030, 2035, and 2040 curves, we see that these curves shift to the right. Basically, it means that the number of hours with null price, zero prices, increases in the future. And this trend is already observable between 2023 and 2024, where we see null and negative prices increase in 2024. The rate at which negative price will increase in the future depends on the development rate of renewable energy. If we increase the capacities of solar and wind onshore and offshore, of course, there will be cheaper energy on the power system. So it will likely increase the number of null prices. And it also depends on how fast power demand increases and if power demand increases, because so far we see a slight increase in power demand, but it's going maybe lower than anticipated. So if the pace of power demand increase is not very fast, well, there will be a mismatch maybe between installed capacities and power demand. So, yeah. Now looking at the actual dispatch, the electricity dispatch. So here we have an example of Spain production in the month of May. And this is a 3-day, so basically the production during 3 days. We see very distinct in orange, the solar production every day, in purple, the nuclear production. And yeah, what happens basically when solar hits its maximum output, basically we see in negative values that the country is exporting, and also the country is using its hydro capacity to pump hydro. So it's and yeah, the pump hydro restore the electricity during the nights. So we see that this happens every day at noons, basically every day when there is abundant production of cheap electricity. And this is coherent with the curve price here in gray. And if we look at the end of our curve, the price increases because there is no more sun, of course, it's night, but also because the wind has faded. There is no more wind production. And so in place, there is a slight increase of nuclear and hydro production. So basically, there is a very important role here of the hydro, pump hydro, especially pump hydro, to create flexibility for the power system. And we also see that nuclear can provide some of this flexibility. Now, I'll delve a little bit into the curve prices that we have obtained from our model. So here we look at the country Spain and the inner base, so business as usual. And I have 3 axes to analyze this graph. So the first axis is basically the evolution from 2027 to 2040. So if we compare each year spot prices, we see that low prices, there are increasing low prices. However, the maximum price increases, but very, very slightly. Overall, the gap between the highest and the lowest price remain more or less similar between 2027 and 2040. What's interesting here to note is also that there is a seasonality to these low spot prices, to these 0 spot prices here. And here in Spain, they seem to happen, especially in May, but also maybe in as early as March or April up to June. So April, May, and June in Spain are associated with of course, a lot of solar generation, but some wind. And also it's a season where snow melts. So snow fills the hydro dams and hydro storage. And also it's a season where it can rain a lot in spring. So yeah, these seasons are associated with a lot of renewable energy production, and it returns null prices. Now, if we compare this to another scenario, which is the inner blue scenario. So in the inner blue scenarios, we consider the NDC of each state. So meaning each state has installed capacity to reach its Paris Agreement objectives. And we see here that negative prices, well, there are many more number of hours with negative prices. And also the season at which they happen spans across almost all year except winter. And if we now compare to another country, for example, if we compare with Belgium, well, the curve price is quite different. And we also see an increase of the number of negative null prices. And the seasonality here, however, is slightly different because we see that the prices are mostly very low null around July in 2040. And it's quite logical after all, because in Belgium, like the season where the demand is the lowest would be, of course, the summer months, and it's also the season where there would be abundant solar energy and maybe wind, of course. We also see the influence of the French market, because we see that the price, especially in 2027, is often set around maybe 27 euros per megawatt hours. And it is a price, the marginal cost we assume for our nuclear French power plant. So it's actually the price of the French market that influences Belgian prices. Overall, this raises a question regarding the remuneration of the actor and of the power producer. As of today, we still need a lot of gas-fired power generation in Europe. If you look at the curves in the bottom right of here as the slide, we see that many countries still use a lot of gas-fired power plants. And these gas-fired power plants, if you look at the graph just above, have seen the revenues decrease over the last few years, especially from 2022. And what we forecast from our model is that the revenues of power plants, gas-fired power plants, is probably set to decrease up to 2050. On the short term, it also means that there is a risk for these power plants regarding their revenues, because revenues from the spot market will decrease, and so there is a need to diverse their revenue stream using maybe capacity market or balancing of flexibility. And this diversification is really key for this power plant to stay in the market and to not dismantle or mothball and go out of market. Another aspect of this remuneration, especially for renewable producers. So we already saw that capture price have been decreasing. And what we see here is that there is an increasing amount of their production that's going to be curtailed, meaning excess production compared to the demand. So since there is no one who's willing to consume this energy, it's basically just thrown to the drain. And yeah, this increasing amount of curtailment means that for renewable producer, it's quite a catch, because they have a lower capture price, but also part of the production is going to be curtailed, and there are going to be choices that will have to be made to choose who's going to be curtailed.
Okay. Before going into the conclusion, I just wanted to say a quick reminder. If you want to ask questions, ask it directly in the Q&A widget in the Zoom interface. So we will centralize the question that way. Now, once we've seen all this, it's important, I think, to take a step back and keep in mind what are the objectives for Europe Energy Future. I think if you read the recent publications from the European Commission, European Parliament, the Draghi report, for instance, there will be no surprise that there is a need for both the security of supply of the European energy system, and a topic that we haven't covered in that field is the security in terms of raw materials and capacity production, but that's for another webinar. At the same time, we need to achieve the decarbonization of the energy systems, and those two goals are actually heavily connected. And third, we need to keep our energy supply competitive if we want to be able to keep developing our industries, if you want to be able to achieve a sustainable poor prices for domestic and tertiary consumers. However, what we've shown in our results here is that if we keep the decarbonization pathways that Europe has been leading over the last years, it will mean a sharp drop on the power market spot prices. In particular, it will mean an increase of the number of hours we flow or negative prices, and therefore a drop of solar capture price in particular. But also, at some point, it will impact the wind capture price. And therefore, if we pursue these objectives, it will also imply a new cost structures. Our cost systems will be based of basically more capex, less opex, more fixed cost, less variable cost, and thus it needs new remuneration models. Market players that used to have 90% of its remuneration on the spot market today might not be able to do so in the coming years. Also, one of the points that may come from uh, the lack of, let's say, the spread between the generation cost of gas and coal is the lack of inframarginal rent for gas power producers. We haven't developed it yet, but it also means that when one technology is always the one setting the highest price and it's always bidding at its marginal cost, it never compensate for its fixed cost. To do so, there is a financial risk that must be shared between players, between stakeholders to achieve Europe's energy futures. The question here is largely political. We need to find a balance between the profitability of market players, in particular power producers, the competitivity of the industry, and do we need to favor specific industry, electro-intensive ones, specific strategy sectors, and we also need to keep the citizen purchasing power in order uh, to keep our internal demand, basically. We want to close this presentation on positive notes because solutions exist at different levels. To reduce our dependency, I think the Draghi report mentioned already the identification, the grouping of gas purchases, but what's, let's say, the key topic of our presentation here is the remuneration of poor and flexibility producers. How will we compensate for this decrease of spot markets? There has been in the last years a strong development of capacity markets, for instance. There have been engaging discussions on the development of clean flexibility PPA. There has been engaging discussions at multiple levels. Can talk about Google, about Engie, but other market players as well on the development of 24/7 clean electricity to ensure an hourly matching of clean electricity production and the associated remuneration. There is an ongoing, especially if you read the latest ASER reports, trend and strong incentive from Europe on the evolution of tariff structure for TSOs and DSOs to encourage a stronger development of OPEX-related solutions and at tariff level to incentivize both producers and consumers to adapt their load or production profiles to this non-dispatchable production. And therefore, it also leads to the development of price signals to encourage flexibility, which will lead to development of hybrid markets. In particular, for instance, with the development of coupled solar and battery power assets, where today most of existing power plants, at least, are mostly focusing on the production only. We did not answer all the questions. We did not answer the question on what will be the final impact on the consumer's energy bill because we don't know it. And even if there is a consensus on this decrease of spot prices, on this increase of cost, the impact it will have on the final bill will heavily depend on both political choices, on the rate at which demand electrification will be growing. We did not answer the question on how cost and risk should be distributed, which mechanisms is the best. We believe at Data that there is no one-fit-all solution, and it will be heavily dependent on the national context and even sometimes regional context. And finally, among the potentials that exist, there will be a lot of discussion can forecast easily in the coming years on the remuneration of flexibility assets and the evolution of how to value this flexibility, in particular long-term flexibility. Thank you. Okay, we had a few questions. We are going to dive into them. So first, I'm discovering them at the same time. Could you elaborate on how spot prices evolution will influence PPA's prices and how increasing PPA volumes contracted are influencing the day-ahead market price formation in countries where PPA volumes have to participate in the spot market? So for PPA prices, there are different methodologies to estimate what should be the right PPA price. But key elements is that first you need to have a price that is above your LCOE, meaning that if you're a power producer, you don't want to sell your electricity and losing money. So that you will tend not to sell electricity below this cost, and also the maximum price or the just price will usually be defined by the capture price. So what will be the remuneration of the market of the power producer if it had sold all its electricity on the market, to which we usually add risk premiums. Which translate the fact that, for instance, an industrial company will be really ready to pay a premium compared to this spot price that it could have gotten on the market, on a risk that the price will not be what is forecasted, a risk on volumes as well. So accumulation of different risk factors, and that's how the spot price evolution influence PPA prices. For the second part of the questions, how increasing PPA volumes contracted and influencing the day-ahead market price formation. It heavily depends on the way that those PPAs are built. So for instance, today, we spoke a few weeks ago, for instance, with a wind developer that they already need in France, for instance, to curtail the wind production during negative prices for wind parks that are in CFDs, so complément de rémunération in French. But they now start to see private PPAs during which the aggregator or the supplier is requiring for the production to be shut down during negative prices. And our expectation to that extent is that we will see, and we said it already, we'll see an increase of low prices hours, but we might see a reduction and maybe even a disappearing of negative prices hour, because negative prices can be managed. This example on PPA contract is one way to do it, but not the only one. But low prices in the current market behavior and in the current market design seem to be, let's say, more predictable at least. New question? Do you want to take this one, Adrian? I'll take it. What are your hypotheses for the projected prices? Are the prices only based on marginal cost, or are they taking bidding strategies into account? Oh.
So yes, actually, I answered this question in the chat right now. So prices from our model are prices based on marginal cost of power plants, and they also take into account, to some extent, some unit commitment constraints from a familiar with system. However, they do not take bidding strategies into account. This would require an agent-based modeling, but also in addition to an agent-based modeling, you would need agents that would own several power plants. So you would need like a portfolio for each agent to actually represent who's most risk adverse and who's least risk adverse. And of course, the size of each agent portfolio has a lot of influence on its bidding strategies. And so we did not go for this type of model as it has a higher level of complexity and also a higher amount of hypotheses, and hypotheses are easily discussed. So we kept with a simple fundamental models, which is easier to discuss.
Maybe to add something here, we do have for gas and coal bidding strategies to take. Yeah, Adrian mentioned unit commitments to take into account, for instance, the fact that it might be worth it for a market player to bid very low during some hours where its power is not needed, to bid higher on the rest of the day. So this is something we take into account in our model. However, and I'm sending a message here, one of the key question is what will be the behavior of low marginal cost technologies like hydropower, like batteries, in the future when they are the one that set the price. Meaning, because today, if you are a BESS developer, you'll most certainly not set the price, and you can buy your electricity during low prices, sell it during high prices. But if during a whole week the prices are at zero or close to zero, how will you behave? Will you decide to bid higher, but then one of your competitor might decide to bid lower up to down to zero? Will you only sell below your LCOS, but then again, if you don't sell at the end, you don't get any remuneration? So today this is a limit, I think, of all power models. And if some of you here are willing to also maybe discuss go into more detail into potential future strategies, long-term strategies for the behavior of batteries in a market where they are the ones setting the price, do not hesitate to contact us directly. Last question maybe, and then we'll have to close this webinar. How are energy trading companies impacting the future foreseen challenges? What is the role that they can take? I won't have much feedback on this. One impact, though, one point for energy trading companies. So I'm not sure here if you're talking about the people trading or the trading desk like Apex or Notpol. For the trading desk, there is definitely a role that they can take is the supply of maybe more adapted products, for instance, to differentiate between peak hours and base hours. The one they are providing today are not necessarily a reflection of the days of low prices that we see. Yeah, don't know if you want to add something on this, Adrian. Okay. And I think we'll close here. We'll answer by mail the remaining questions. And thank you very much. Do not hesitate to contact us directly. There is a mail at the end of the presentation that you will receive if you have any complementary question, if you want to discuss more about our model, or if you, because associated to this model. We already provide so of the shelf for price projection for multiple countries in Europe. So if you're interested in this, do not hesitate to contact us directly. Have a good day.